In physics, there is this comforting law we all learned in grade school.
Right, Newton's third law.
Exactly. Every action has an equal and opposite reaction. You push a wall, the wall pushes back.
Yeah, it's balanced.
It's predictable. It makes sense of the physical world.
It gives you this sense of order, like a neat little equation where everything eventually zeroes out and equilibrium is restored.
Right. But when you look at the global economy, through the stack of sources we're diving into today, it feels like someone completely broke the equation.
Oh, absolutely.
We are asking this, frankly, terrifying question. What happens when the action on one side of the scale just becomes completely infinite?
Well, the reaction on the other side becomes violently scarce.
Yeah.
And that tension between infinite digital abundance and finite physical reality, that is the single force ripping through every market, every startup, and every sovereign bond right now.
And that is exactly what we are unpacking today. Welcome, everyone, to the Deep Dive. We have an incredible set of sources today.
We do. We're pulling from interviews with top venture capitalists, some really cutting-edge quantitative macro analysis, and real-world pitches from everyday bootstrapped entrepreneurs.
Yeah, our mission here is to connect the dots. On one side, you have the explosion of artificial intelligence. And on the other, the absolute unyielding scarcity of government debt and physical assets.
Right. And to understand the sheer panic and, honestly, the massive opportunity here, we have to start by analyzing the technological shock hitting the system.
Because the narrative has completely shifted, hasn't it?
Completely. We've moved from digital AI to physical robotics.
Yeah, and Andrew King's thesis is, the perfect lens for this. He runs RoboStrategies, which is a new NASDAQ closed-end fund.
Right, and they charge a 2.5% fee with zero carry, which basically gives public investors a backdoor into private robotics companies.
Exactly. And Kang points out something that, well, it feels obvious in hindsight, but it has these massive structural implications for the global economy.
Which is that humanoid robots aren't just a cool tech upgrade.
Right. They're stepping in to solve an immediate global demographic crisis.
Yeah, because if you look at it, we are facing shrinking populations across Western nations and parts of Asia.
And the baby boomer generation is aging out of the workforce.
Exactly.
Yeah.
There simply aren't enough young human beings to fill the physical labor jobs required to just, keep the baseline physical economy running.
We aren't talking about writing code here.
No, we are talking about moving boxes, building houses, harvesting food, real physical tasks.
And the scale is almost hard to process. Kang noted that Amazon will soon employ more robots than human beings in their logistics network.
Wow.
Yeah. And when a company productizes human labor itself, the total addressable market, the TAM, is no longer measured in billions. It's in the tens of trillions.
It effectively becomes the largest total addressable market in the history of capitalism.
Right.
Because you're replacing or at least augmenting the foundational input of the entire global economy, which is human physical effort.
Okay, but I want to push back on the enthusiasm here for a second.
Sure, let's hear it.
Let's just trace the logic. If AI and robotics eventually make both intelligence and physical labor basically free,
Yeah.
doesn't that inherently destroy the value of traditional technology businesses?
How so?
Well, it feels like we are giving everyone on Earth an infinite printing press for intelligence and labor. And if everyone has one, suddenly being a tech wizard isn't a competitive advantage anymore.
Ah, I see what you mean.
Right? Your margins should theoretically just collapse to zero.
Well, you're actually hitting on the exact mechanism that's killing traditional tech growth right now.
Really?
Yeah. Jordi Visser, one of the macro analysts in our sources, calls this phenomenon multiple compression.
Okay, let's break that down for the listener because it's a really critical concept.
Definitely. Multiple compression essentially means the premium investors are willing to pay for a company's future earnings completely shrinks.
Think about it mechanically, right? In the stock market, you might pay 30 times a software company's current earnings because you assume they have a 10-year runway of dominance.
Exactly. But if the deflationary pressure of AI means 3 kids in a garage can clone that software in a weekend using AI coding agents.
Which they can now.
Right. Then year 5's earnings are suddenly a massive question mark. And year 10's earnings might literally be zero.
So the multiple you are willing to pay today compresses instantly.
Because why pay a premium for a moat that no longer exists?
And it's not just the small guys. Even the absolute giants like OpenAI and Anthropic are facing this existential threat from open source models and AI routers.
Oh, the routers are fascinating.
I was completely floored by the Stripe acquisition in our stack. Stripe just bought a company called OpenRouter for $78 billion.
With a B.
Yeah, $78 billion. And they didn't buy an AI model. They bought the routing layer.
Which is the system that decides which AI model your prompt gets sent to.
Exactly. They're betting that the intelligence itself is becoming a raw commodity.
Right. If you control the switchboard, you hold the power. The individual models just become interchangeable utility providers like electricity or water.
Stripe is securing the toll booth, not the utility itself.
Exactly. And you see this hyper-automation eroding traditional moats everywhere. Take the company Overlap from our sources.
Oh, this was wild.
Yeah. They built an AI video agent that generated 2 billion social media impressions without a single human in the loop.
2 billion.
Without a human. The system just ingests long-form video, edits it, identifies the viral moments, writes the captions, and posts it based on real-time algorithmic performance data.
So when AI shrinks what used to be an entire year of a marketing team's human labor into 70 days, or instantly, in Overlap's case.
The terminal value of a traditional software or media company evaporates.
Yeah.
Because if your competitive advantage was simply, well, we know how to execute these digital workflows.
You no longer have a business.
Precisely.
So if software and digital labor are trending toward a cost of zero, creating this world of infinite deflationary competition, where does the smart money go?
It runs in the exact opposite direction.
It seeks out absolute finite scarcity.
Right. They are hunting for assets that cannot be printed, coded, or replicated by an algorithm.
But they aren't just outrunning the artificial intelligence shock, are they?
No, they are simultaneously trying to navigate a deeply fragile government debt situation.
And this is where the macro environment completely collides with the tech narrative.
It really does.
According to the analysis from 42 Macro, the United States is currently running record deficit spending.
But we are not in a recession, and we are not fighting a world war.
Right. And historically, those are basically the only two scenarios that justify borrowing at this velocity.
Yeah, 42 Macro refers to this structural condition as the debt disease, or paradigm A.
Debt disease.
When a sovereign nation accumulates this much debt relative to its GDP, history dictates they have very limited escape routes.
Okay, like what?
Well, they can aggressively cut spending, which is, politically toxic and almost never happens.
Fair enough.
They can attempt to grow the economy faster than the interest on the debt accumulates.
Which is hard.
Very hard. Or they have to manipulate the system to ensure there is always a buyer for that debt.
Which brings us to what they call paradigm D, print the demand.
Exactly. And the Treasury is actively managing this transition right now through a maneuver called Besant's Bridge.
Okay, I want to make sure we nail the mechanics of this for you listening. Why does Besant's Bridge matter? What are they actually doing?
So Treasury Secretary Scott Bessent is effectively buying back long-duration Treasury bonds and replacing them by issuing short-term bills.
Okay, but why does swapping long-term bonds for short-term bills matter?
Because if the government floods the market with 10-year or 30-year bonds to fund these massive deficits, buyers are going to demand higher interest rates to take on that long-term risk.
Right, that makes sense.
And if long-term interest rates spike, mortgages become unaffordable, corporate borrowing freezes, and the whole economy basically stalls out.
So to prevent that, the Treasury just artificially limits the supply of those long-term bonds.
Yes. By buying them back and issuing 30-day or 90-day bills instead, they constrain the supply at the long end of the curve.
Which artificially caps long-term yields.
Exactly. They are masking the true cost of the debt.
So they are manipulating the bond market to prevent the system from throwing a fit.
That is one way to put it, yeah.
Well, I mean, we have a government artificially managing borrowing costs, while AI destroys the value of traditional growth stocks.
Right.
When you look at it through that lens, Jordi Visser calling Bitcoin the purest AI trade makes absolute sense.
It really does. Bitcoin represents the ultimate hedge against both of these forces.
Because it's mathematically finite.
Exactly. A central bank cannot print more of it to fund a deficit, and an artificial intelligence cannot code more of it into existence.
It's just capital seeking a hard, unyielding guardrail.
Yeah, and the sources highlighted that Bitcoin recently had a massive 7 sigma week. It surged 23% and broke right through its 200-day moving average.
Okay, wait, explain the 7 sigma event for us.
So to put a 7 sigma event in perspective in statistics, 1 sigma is just a normal deviation from the average. A 3 sigma event is rare.
Okay.
A 7 sigma event is essentially a statistical impossibility under normal conditions. It's like flipping a coin and getting heads 100 times in a row.
Wow.
Right? It signals a fundamental structural break in the system. The market was violently repricing the reality of absolute scarcity.
Okay, I have to stop you, though, and challenge this narrative.
Go for it.
If Bitcoin is the absolute ultimate hedge against AI abundance and sovereign debt, why did 42 Macros own quantitative portfolio, their KISS portfolio, literally just sell all of their Bitcoin?
Yeah, that's the million-dollar question.
I mean, the sources show they dropped their exposure to 0%. You can't call it the ultimate hedge and then dump it.
It sounds totally contradictory, I know, but it perfectly highlights the tension between a long-term macro thesis and short-term survival.
Okay, how so?
Well, the KISS portfolio, which stands for Keep It Simple Stupid, is a strict, emotionless, quantitative risk management overlay. Right now, it is sitting at 10% cash in floating rate treasuries, 60% stocks, 30% gold, and 0% Bitcoin.
But why zero Bitcoin if the underlying thesis for finite scarcity is so mathematically sound?
Because of a proprietary metric they use called VMS, volatility adjusted momentum signals.
VMS.
Okay.
Yeah.
VMS doesn't just look at whether an asset's price is trending up or down. It evaluates the momentum relative to how choppy the trading is.
Oh, I see.
And Bitcoin broke down to a bearish signal on this specific model because in the short term, global liquidity, the actual cash flowing through the financial system, is drying up.
And when liquidity contracts, it drains from the furthest, riskiest edges of the risk spectrum first.
Exactly. Bitcoin acts like a financial seismograph.
It doesn't cause the earthquake, but its hypersensitivity registers the tremors of tightening liquidity long before the broader stock market feels the ground shake.
That's a great way to put it. 42 Macro is systematically avoiding what statisticians call a type 2 error.
What's a type 2 error in investing?
It occurs when you ignore a blaring mathematical risk signal because you are blindly loyal to your long-term narrative, and as a result, you blow up your entire portfolio.
Ouch.
Yeah, you can absolutely be wildly bullish on Bitcoin's role in the year 2030, but you still have to step aside in 2026 when the quantitative signals tell you a liquidity crash is imminent.
Because narrative does not equal timing.
Exactly.
You can be right about the decade and still go bankrupt this Tuesday.
That is the harsh reality. And the volatility difference driving these models is just staggering right now.
Yeah, the sources pointed out that Micron, which is a massive established semiconductor company, has a 60-day volatility of 120,
Right.
while Bitcoin's volatility was only 24.
It's crazy. A traditional chip stock is currently 5 times as volatile as a cryptocurrency.
The traditional risk landscape is completely upside down.
It really is. We are watching billionaires place generational bets on humanoid robots, while macro hedge funds use strict, emotionless math to hide in gold and cash to avoid being trapped by government debt and liquidity cycles.
It's wild. But if you were listening to this and wondering, like, what do global liquidity cycles and 7 sigma events have to do with me? Or how does a normal person survive this?
That's the real question.
Here's the thread that connects the macro to the micro. How does an everyday founder respond to this bifurcated economy?
They completely ignore the digital arms race and go aggressively into the messy, unscalable physical world.
Right. The pitches from the My First Million sources were incredibly revealing on this point.
Oh, they were fantastic. We are seeing a new wave of founders leaning heavily into hyper-niche, physical, sweat equity businesses.
These are the arenas where AI cannot easily replace you, but where you can use AI as leverage to scale massively.
Yes, it's all about physical moats.
Take Nick, one of the founders highlighted in our sources. He acquired a decidedly unsexy business called On Point.
Right, they sell and service backup generators for telecom towers, nursing homes, and data centers.
It is grueling physical work.
But that unsexy business is doing $12 million in annual recurring revenue and is projecting $25 million.
That's huge. And then there's another founder, Kevin, who left a comfortable tech job to buy a franchise called Smash My Trash.
I love this one.
He bootstrapped it and sold it for $1.8 million. And his entire business model consisted of driving a truck with a giant spiked roller on the back to industrial parking lots and physically smashing the garbage down in their dumpsters.
So the facility didn't have to pay for as many waste pickups.
Exactly. It's totally uncontested territory. The brightest minds from Stanford are not trying to disrupt the industrial dumpster smashing space.
No, they are definitely not. But the crucial takeaway here is how these specific founders are utilizing artificial intelligence.
Right, they aren't trying to build the next OpenAI.
Exactly. They are using AI as an internal wedge to widen a physical moat.
Like Nick's generator company. His biggest operational bottleneck was speed, right?
Yeah, when a hospital's backup generator breaks down, a technician has to physically go there, diagnose the issue, dig through decades of obscure physical manuals, and then manually generate a technical quote.
Which takes weeks.
It did take weeks. So Nick took all of his company's historical tribal knowledge, every past quote, every maintenance manual, every schematic, and fed it into an internal AI retrieval system.
That's brilliant.
Yeah. Now his mechanics can stand next to a broken generator, speak their observations into their phones, and the AI instantly generates a highly technical diagnostic report and a perfectly priced quote.
Wow. So he is treating AI purely as a back-office utility to dominate a deeply analog market.
Precisely. And we are seeing this same niche moat strategy applied to digital businesses too, provided they focus entirely on human emotion and highly specific ignored communities.
Yeah, the sources gave us a fascinating example of a 24-year-old making $430,000 a month selling a 3D printed heated jaw massager.
Almost $500,000 a month.
Right. And he didn't build a generic wellness brand. He targeted the TMJ chronic pain community.
Which is a highly specific group of people who felt completely ignored by mainstream medicine.
Exactly. He used technology to identify and manage the supply chain, but the core of the business was solving a hyper-specific, deeply emotional physical pain point.
Hot Plate is another prime example from the sources. They're doing $100 million in gross merchandise value.
And they operate basically as a Substack for food, right?
Yeah. They allow pop-up at-home bakers to bypass the crushing physical costs and debt of opening a brick-and-mortar restaurant.
So these bakers just sell directly to their local social media followers and coordinate neighborhood pickups.
Exactly. Hotplate is simply leveraging digital technology to facilitate a uniquely human, local, physical interaction.
The example that really challenged my assumptions, though, was an app called Tolan.
Oh, the alien.
The AI alien companion app. It costs $25 a month, and they have over 100,000 paying subscribers.
It's unbelievable.
And the core demographic is Midwestern mothers.
Yeah.
Like, why would someone pay $25 a month to talk to a digital alien on her phone when she can just download ChatGPT for free?
Well, it reveals the fundamental blind spot of big tech. The tech giants are entirely focused on IQ.
Right.
They are spending billions to build the smartest possible models to help enterprise companies maximize their return on investment.
They want to automate coding, optimize legal briefs, streamline logistics.
Right. But a user getting home from a chaotic day doesn't want enterprise logistics.
Right.
You want emotional utility. Tolan isn't designed to be a genius. It is designed to be a companion with a perfect memory.
Okay, yeah.
The core value proposition is helping users close mental tabs.
Closing mental tabs. I like that.
Yeah, so a user can vent to the alien about the stress of planning summer camps or figuring out weekly meal prep, and the AI remembers those details, brings them up proactively later, and helps the user sort through the invisible mental load of daily life.
So while the giants fight over raw intelligence, indie founders are finding massive success focusing on emotional connection, physical presence, and niche communities.
Exactly.
So let's pull all these threads together for you. We are standing in the middle of a profoundly bifurcated economy.
We really are.
On one side, the infinite digital abundance of AI is crushing traditional tech growth through multiple compression, basically turning digital intelligence into a basic commodity.
Right, and to survive the macro side of this, you have to own scarce, finite assets.
And you have to manage those through strict, emotionless, quantitative risk models that respect liquidity cycles.
So you can outrun the government's massive debt manipulation, yeah.
But the alternative path is to move into the messy, physical, hyper-niche, real world.
You find a community with a deep emotional or physical need, and you treat artificial intelligence not as your shiny new product, but as your most efficient, invisible back-office employee.
In an incredibly wild landscape to navigate.
Yeah.
But before we wrap up this deep dive, there's one final provocative concept from the sources that kind of bridges everything we've talked about.
Oh, this is the big one.
Yeah. If you look at the physical requirements to actually build the robotics revolution we discussed at the start, it is staggering.
It really is. Andrew King noted that just the actuators, which are the complex mechanical joints that allow humanoid robots to move smoothly, make up 30 to 50% of the robot's total costs.
And manufacturing them requires micron-level tolerances and massive, heavy industrial machinery.
Right. building millions of humanoids requires an unbelievable amount of physical capital, raw materials, and energy.
You can't just code a factory into existence. It takes steel, concrete, and real-world investment.
And here is the twist, remember, Paradigm D and Besant's Bridge.
Right, the sovereign debt.
If the United States government continues to aggressively borrow capital to fund record deficits, they are absorbing the liquidity in the system.
They are actively crowding out private investment.
Yes. So the ultimate question is this. What if the true bottleneck to the AI and robotics revolution isn't a lack of computer chips or a limitation in software intelligence?
Wow.
What if the revolution stalls because there simply isn't enough cheap physical capital left to build it because it was all consumed by runaway sovereign debt?
It brings us right back to Newton's scale, doesn't it?
It does.
The unstoppable infinite force of artificial intelligence is finally meeting the unyielding, immovable object of physical and economic scarcity.
Absolutely.
Well, it's definitely something to think about as you watch these two completely different worlds collide. Thanks for joining us on this deep dive. We'll see you next time.